how do financial systems actually stay stable? With all the economic shifts happening globally and right here at home.
It's a constant balancing act, isn't it?
Exactly. And that's what we're digging into today. We're looking at some really key announcements from Nigeria's central bank, the CBN, about the banking sector.
Mm-hmm.
Our goal here is pretty simple. Pull out the important bits and explain why this stuff actually matters to you.
And we're aiming to go a bit deeper than just the headlines. We want to shed light on let's say, the underlying strength and the strategic thinking going on within Nigeria's financial system.
Okay, so let's unpack this. What's the core news coming out of that recent CBN meeting? The one with Governor Cardoso.
Well, the big takeaway from the MPC briefing on July 22nd is that 8 Nigerian banks, they've successfully met the minimum regulatory requirement.
Okay, 8 banks.
Yeah, under the current forbearance regime. And there are specific examples like Guarantee Trust Holding Company, GTCO.
Right, I saw that. They raised quite a bit of money, didn't they?
A significant amount, yes, through a public listing over on the London Stock Exchange, the LSE.
So this forbearance regime, what exactly does that mean in practice? Is it something unusual?
That's a great question. What's fascinating here is understanding what it is and what it isn't. These measures, they're temporary.
Temporary, okay.
Yeah, temporary allowances. They're designed to help banks sort of build up their capital buffers gradually, especially during transitional times. Think of it like financial breathing room for a bit.
Makes sense.
And it's really important to get this. These steps aren't new, and they're definitely not unique to Nigeria. It lines up perfectly with global standards, like Basel II, for example. It's a standard tool in the financial regulation playbook worldwide.
Okay, so standard practice just applied here. But the good news isn't just about those 8 banks, right? What about the health of the whole sector? How's it looking overall?
That's really the crucial point. The entire Nigerian banking sector is officially seen as fit for purpose.
Fit for purpose.
Yeah.
And that's backed by numbers.
Absolutely. Solid data. We're looking at a Capital Adequacy Ratio, the CAR, of 13%.
13%. Is that good?
Yes, that's quite healthy. It basically means banks have a strong cushion, a buffer, to absorb potential losses. It shows resilience.
Okay.
And then you've got a strong liquidity ratio too, around 50%. Plus, non-performing loans, NPLs, they're sitting comfortably inside the 5% regulatory limit.
So low bad loans, plenty of available cash, strong capital.
Exactly. Taken together, these figures paint a picture of a pretty sound and stable banking system. One that seems genuinely capable of handling economic shocks and, importantly, keeping investor confidence up.
And speaking of investors, you mentioned confidence. What's the vibe from outside Nigeria? Are international markets noticing?
They are. We're hearing that international market participants, the ones who've been watching Nigeria's financial scene for years, they're saying things like, this looks like the right time to re-enter the market.
Wow. Okay. So they see opportunity.
They definitely see opportunity. That's a pretty strong vote of confidence, right?
It absolutely is. Now, beyond the banks themselves, that same MPC meeting made some big calls on the wider economy, didn't it? Like interest rates.
That's right. The CBN decided to hold the main interest rate, the monetary policy rate, or MPR, steady at 27.5%.
And that's the 7th time in a row they've held it there.
The 7th straight time, yes. They also kept the asymmetric corridor around that rate. That's the plus 500 minus 100 basis points band.
Right.
And the cash reserve ratio, the CRR, also stays put. It's 50% for the main deposit money banks and 16% for merchant banks.
So keeping things tight, why hold rates so high, especially for so long? What's the thinking there?
Well, it raises that exact question. The CBN's stated reason is mainly to sustain disinflation. Basically, to keep downward pressure on inflation and stabilize prices, even though they see some signs inflation might be moderating a bit.
So inflation control is still the top priority?
It seems so. Keeping the MPR and CRR elevated signals, they still want to tighten liquidity, mop up excess cash, and support the Naira.
But there's always a trade-off, isn't there? High rates can make borrowing expensive.
Precisely. It's a balancing act. While they're focused on price stability, holding rates this high does tend to restrict credit growth, and that can slow down overall economic expansion. It's a choice they're clearly making right now.
Okay, so putting it all together, what's the bottom line for someone listening to this?
I think it paints a clear picture of resilience in the Nigerian banking sector. You've got banks strengthening their positions, meeting requirements, and you have a central bank making some tough strategic calls on monetary policy, really focusing on achieving that long-term stability, particularly with prices.
So resilience and strategic focus.
Yes. And maybe final thought to leave you with. As the CBN keeps walking this tightrope, balancing tight money policy with keeping the financial sector stable, what could that mean down the line? Think about the potential impacts on broader economic growth, or maybe how easily businesses can access credit? And perhaps what new opportunities might these reforms actually open up for Nigeria's economy, especially now that international investors seem to be taking a fresh look?